markets mostly lower as we start the week after last Friday's bloodletting. And it's a quiet week on the macro front. So what we're going to do here is try to unpick what's gotten everybody so spooked all of a sudden, what it means going forward. This is Ilya Spivak, head of global macro here at tastylive. You're watching Macro Money. And the question that is in front of us once again is whether we need to be worried about recession, because that is precisely the level of fear that seems to be permeating the markets here as we start the week here in the wake of what we saw on Friday's set of numbers, as well as, of course, on the price action that resulted. So let's first and foremost take a look at how last week shaped up across major markets and ground ourselves in that evidence, and then see what all this seems to be about. We can see here, bad week last week for stocks. S&P 500 down 1.7%, NASDAQ off 2.3%, yields down across the board, heavy move lower in excess of 1%, both at the long end, the 10-year, and the front end. The 2-year crude oil also lower for a second consecutive week, down 0.5%. A bit of a hodgepodge for the dollar, but probably the most critical bit here is the yen with a strong rise of 2%, and gold nearly pacing that with its own rise of 1.8%. Now, clearly, there is a thematic narrative that emerges here, and it is one of negative perspective on risk-taking in general, on risk appetite as a whole. And that's the kind of thing that happens when the markets get worried about global growth dynamics. So stocks are down. Bonds are up. That is to say, yields are down. That pullback in yields giving support to the typical and usual suspects, gold and the yen, both of which tend to benefit when yields are lower. The euro somewhat neutral here, but of course we were going into German elections this past weekend. They've since occurred, and we'll see how the coalition building proceeds from here. But the overall story, Bitcoin included, with a loss of 3% last week, is of the markets becoming more defensive. And with crude oil falling in line with these themes, the essence of the worry seems to be growth related. Now, this is after some very sobering economic data that came out on Friday. What we find here is the latest update on U.S. growth dynamics from S&P Global's Purchasing Manager Index survey. What we find here, first, the good part, manufacturing picked up a little bit of steam. We can see here the red line tracks that sector. It rose to 51.6, a very small rise from January, but nevertheless, a bit of acceleration. That was hardly the story, though. The main issue came from the service sector, the much more dominant part of the equation. In fact, you can see that manufacturing here sort of moves onto itself for the most part, but the overall composite index that includes both manufacturing and services looks almost identical to the service sector line, and that's, of course, because the U.S. service sector is close to 70% of the entire economy and close to 80% of employment. So clearly there is a disparity here, and services is the more dominant part of the story. What we see is actually rather shocking. The service sector shrank for the first time in over 2 years in February, looking at this data. As ever, it operates on a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. The number for February here on the service sector, 49.7, that is to say below 50 and pointing to contraction. The composite number, as a consequence, 50.4, just a sliver above utter standstill, and the weakest performance in 17 months. So the U.S. economy here clearly showing signs of significant unraveling at the start of the year. Moreover, if we look at the index tracking forward-looking expectations within the data, it is looking ominous. At the start of the year here, we can see a brisk drop in forward-looking expectations for where purchasing managers expect things to go from here. Now, we're not in contraction territory yet, but as it stands, the level of confidence about future output has significantly diminished. And indeed, if we look at the bottom line here for what is being reported, we can see why. On the service sector side and more generally, we can see what this cites is growing concerns and uncertainty related to federal government policies as a reason why businesses are turning defensive, and so new orders growth is weaker. Business expectations, as we just saw right here, are slumping. The other still more defensive beat here is on that uptick in manufacturing. As we just saw, this was a bit of a bright spot, even though it didn't really change the overall result, but maybe it wasn't as bright as it seems. Surveying suggests that the upturn in manufacturing was at least in part linked to front-running of tariffs. That is to say, importers boosting their activity, boosting their orders from abroad, expecting that tariffs downwind would make those same purchases much more expensive, and so attempting to stockpile at the lower levels, the lower costs now while they can. In parallel, of course, we've seen a similar kind of vigor in China, which has been the main beneficiary of this front running of tariffs. But, of course, domestic demand there has remained anemic all the same. So this does seem to line up with what we're seeing in other data, and again suggests that what little offset from the manufacturing side there has been to the slump on the services part of the equation is indeed something with a short shelf life, at least for now. So why is this so important, and why is this so concerning? Indeed, much of the losses that we see here, much of these moves happened on Friday in the wake of these numbers. So what is it about them that is so very troubling for markets? Well, we've of course just seen the latest update on U.S. inflation figures, and there's really two big insights that we take away from them as pertinent to this conversation. Number one, to the extent that the rise in prices in a given sector reflects demand in that sector, which of course it does, the more demand there is, the more upward pressure there is on the price of stuff in the sector, because of course it suggests that people are competing for resources, and the way they compete is of course on price. So where there is upward pressure on inflation, there tends to be an outsized degree of demand, at least relative to supply. And so what you see, of course, is that overwhelmingly most inflation remains stuck in the service sector, which tells you just how important that is here for overall growth. In fact, it is absolutely critical because, as we can see here, there isn't much of a contribution from elsewhere. So the first kind of upshot here, you can see that of the total 3% inflation rate that we recorded in January, 2.62 percentage points came from services. So that we are seeing the slump that we are seeing right here ought to be a troubling sign because, of course, that's where the demand is. We can clearly see the goods side very much anemic. Secondly, we see that the contribution from this part actually cooled in January, whereas here it became less negative, which will, of course, be consistent, again, with the dynamics we're seeing here. And so when we look at the breakdown here, we can see that the contribution to CPI from goods actually became stronger in January, even though the overall levels we can see are a pittance, and it's because they became less negative month in, month out. But the main weakening, and of course the implied knock-on indication for demand, came from services. So that CPI report is telling us not only that services is still very, very important, but also that this very, very important part is the part where, despite higher than expected CPI numbers overall, we saw some weakness. All of which, again, speaks to the unraveling that we're seeing here. And of course, the implications for the overall composite numbers are troubling indeed. It goes deeper than that, though, because as we've talked quite a bit before on the show, the global economy is made up of effectively three growth engines: the US, the Eurozone, and China. And between them, they have 58% of global GDP. The remaining 42% are less impactful than that total suggests because many, not most, are vendor economies that depend on demand from the larger three. So think Canada and Mexico with the US. Think Central Europe and Eastern Europe and Nordic Europe, perhaps even the UK with the Eurozone. Think Australia, New Zealand, big swaths of Southeast Asia, and commodity-producing Latin America and Africa for China. So we have a situation where the global growth picture is very much reliant on three core economies, and their weight, if anything, is understated by their headline contribution. If we look at what's been going on here over the past year or so, we can see that from the middle of last year, there was a very clear story of the U.S. outperforming. This is the composite U.S. PMI index from S&P Global. We can see this is the U.S. economy looking very, very strong up until these past two reports, January and now, of course, February. At the same time, the situation in China has been of slowdown. The situation in the Eurozone has been of slowdown. Now, we haven't seen the February numbers for China yet. That's next week. But the expectations are for numbers that are about in line with where they've been recently. And indeed, that's been the broader story in China overall. It's not that we're unraveling toward deeper and deeper depths of malaise, it's that the economy is essentially stopped because there is very, very little demand. In the case of the Eurozone, these latest numbers suggest we're just idling at this point, having returned only very nominally to positive growth. The upshot here is until the start of this year, there was a strong skew where global growth was expanding because the U.S. was holding it up, while everything else was flagging. With the U.S. doing this, that last line of defense appears spent. Indeed, if we look at the latest set of global PMI numbers, obviously this is for January. February is not quite there yet for obvious reasons, including the absence of China's data. So we'll get that update perhaps next week. But we can already see that for global growth, what this disparity has meant is that while the US was powering ahead last year, the global average is actually cooling. And the reason it was cooling is because the US wasn't really exporting their strength. Why? Because that strength was mainly in services, as we've just discussed, which is primarily serviced by domestic firms. Look at this outperformance here. Is it manufacturing that's doing it? Clearly not. And of course, that's the part where the US imports mix tends to focus on goods. And what do we see in the CPI numbers? Goods demand is weak. Services demand is strong. And that's, of relatively speaking, to goods, of course. And that's mainly a domestic story. So the global growth pie has at best idled, if not cooled a little bit, over the course of the second half of last year, largely because the U.S. outperformance that we've seen has remained locked onshore. When we see these numbers for February updated, we're likely to see a very dramatic decline for global totals. And of course, what that would portend is a drop-off in global GDP. You can see here the PMI numbers tend to front-run the big moves in the overall global growth numbers. And of course, the fear then is if you've kicked out the last leg of the stool by seeing the U.S. weaken, that global recession is not too far around the corner. You likewise have a situation suggesting that what we're starting to see in the U.S. has followed through. Note this U.S. Economic Surprise Index, which measures outcomes on U.S. economic data relative to forecasts, has dropped deeply into negative territory here. In fact, it is now at the lowest levels we've seen since August, September of last year. So clearly, there is scope for U.S. economic data to continue to underperform, therefore, for the cyclical implications to continue to filter through markets. And this is, of course, where all of this becomes tradable and actionable. We can see that Fed policy expectations currently envision just 65 basis points in rate cuts over the course of this year and through the end of 2026. That's 50 basis points for this year, 17 basis points for next year. Now, if we look at what the Fed itself projected back when it last updated these figures in December, we can see from 2024 to 2025, there's a move from 4.4 to 3.9. So that's a 50 basis point batch of easing here. And then from this year to the next, another 50 basis points in rate cuts from 3.9 to 3.4. Now, for this year, we're about there. We're only about 3 basis points removed. So the markets seem to be fairly aligned with where the Fed is at this point for 2025. We are still quite a bit light relative to what is expected for next year. As a matter of fact, we can see the sum here, 65 basis points through the end of 2026. That's about 35 basis points light of what the Fed itself is projecting. And so the markets are clearly not wholly consumed with recession fears or pricing in that kind of risk at the immediate moment. But of course, if this continues to develop as it has been, and there's deeper disappointments to follow, then this creates quite a bit of room for repricing, even just to get back to the Fed's baseline, never mind overshooting it. And so what we end up with then, as we look at our mix of assets, is a bit more of the same this week, perhaps, as we had last. More room for yields to move lower as bonds rise if we have indeed these cyclical concerns continue to find follow through. More room for the US dollar to weaken against that backdrop. And if indeed what we are concerned about is overall global growth, more room for stock markets to reflect this and for Bitcoin to reflect a larger risk-off bias as well. In fact, one of the few limiting factors on US dollar weakness, with perhaps the exception of the yen, might be an appeal of the dollar as a liquidity haven in this broader risk-off scenario. We've seen, of course, as we typically do, that when stocks take a big leg down, it is the dollar and the yen that tend to outperform the dollar because it is the most liquid destination for cashing out of riskier assets by virtue of being by far the most commercially used currency in the world. 88% of global monetary transactions are settled in dollars, according to the latest figures from the Bank of International Settlements. And the yen, because perennially low interest rates mean that when things are going well, the usual carry trade strategy has been to borrow cheaply in yen, sell that yen, and buy higher yielding assets. And so when those higher yielding assets turn inward and become defensive, the dynamic is to buy back your borrowed yen, so the yen tends to go up so that those loans can be covered. So the dynamics here seemingly setting up for a larger repricing toward a dovish Fed, a more defensive perspective on growth being the catalyst for that. Therefore, the tendency for the price action this week and the immediate term likely to look a whole lot like this going forward. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on with Victor Jones for The Price of Truth on Tuesdays, on with Chris for Futures Power Hour Mondays and Fridays, on with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is going to be back tomorrow. Happy trading.